Welcome back, everyone, to Data Science for Everyone. Today we're going to be looking at
How the central bank executes monetary policy. Federal Reserve's most important function is to create and conduct the nation's monetary policy. Monetary policy involves managing interest rates and credit conditions, which influences the level of economic activity. The most common monetary tools in the U.S. are open market operations, the central bank selling and buying treasury bonds to influence the quantity of money and the level of interest rates. The Federal Open Market Committee, FOMC, makes the decisions regarding open market operations and is comprised of 7 members of the Federal Reserve Board of Governors and 5 voting members of the regional Federal Reserve banks. How open market operations increase the money supply. Table A shows Happy Bank starts with $460 million in assets divided among reserves, bonds, and loans, and $400 million in liabilities, in which the form of deposits, with a net worth of $60 million. Table B shows that the central bank purchases $200 million in bonds from Happy Bank, and the bank holdings of Happy Bank fall by $20 million, and the bank's reserves raise by $20 million. However, Happy Bank only wants to hold $40 million in reserves, the quantity of reserves with which it started. So, Table C shows that the bank loans out an extra $20 million in reserves, and its loans rise by $20 million. The central bank's open market operation causes an expansion of the money supply. How open market operations decrease the money supply. Table A shows that the balance sheet of Happy Bank before the central bank sells bonds in the open market. Table B shows that Happy Bank purchases $30 million in bonds. Happy Bank sends $30 million of its reserves to the central bank, but now holds an additional $30 million in bonds. However, Table C shows that the Happy Bank wants to hold $40 million in reserves, so it will adjust down the quantity of its loans by $30 million to bring its reserves back to the desired level. A bank can easily reduce its quantity of loans by slowing down or briefly stopping to make new loans. This operation causes the money supply to decrease. Changing reserve requirements. A second method for conducting monetary policy is for the central bank to raise or lower the reserve requirement. The reserve requirement is the percentage of each company or each bank's deposits that is legally required to hold either as cash in their vault or on the deposit with the central bank. Greater reserve requirement is equal to less money available to lend out. A smaller reserve requirement equals the greater amount of money available to lend out. In practice, the Fed rarely uses large changes in reserve requirements to execute monetary policy. Changing the discount rate. Third traditional method for conducting monetary policy is to lower or raise the discount rate. The discount rate is the interest rate charged by central bank on loans that it gives to other commercial banks. If the central bank raises the discount rate, then commercial banks will reduce their borrowing of reserves from the Fed and instead call in loans to replace those reserves. Since fewer loans are available, the money supply falls and market interest rates rise. If the central bank lowers the discount rate, it charges to banks. The process works in reverse.